Chapter 10, we're going to really focus on long-term liabilities, specifically, and right now we're just going to look at bonds. Bonds are like debt, or bonds are debt. Most of the time, they're long-term debt. And as a review, long-term means greater than 1 year. Short-term would be less, right? Less than 1 year. So bonds are a form of interest-bearing notes issued by companies, governments, churches, schools, you name it. And probably other organizations I didn't even mention. Smaller denominations usually given in $1,000 increments. So you might have a $10,000 in bonds, but they could be 10 different bonds. $1,000 each, 10 bonds is $10,000. Are similar to smaller amounts that common stock is issued. Well, $1,000 is a lot of money to me, but compared to the millions and billions and trillions of dollars out there, it's small. Advantages, it doesn't affect owner's control because there's no shareholder owner representation given away to a new person by issuing bonds. They don't have an ownership stake. Interest on bonds is tax deductible for the company paying the interest, and bonds may increase return on equity. And what that means is leverage. So a lot of times, people say, listen, I'm going to buy a house, but I don't have all 20% to put down. If you're buying a $100,000 house, that'd be 20 grand. So they'll say, well, look, FHA or whatever is 5% down. So $5,000 down payment can get you into a $100,000 home, or $10,000 down payment can get you into a $200,000 home. That's leverage. You're using a little bit of money to get a lot of asset. Same thing here. That's what leverage is. Using a little bit of your own money and you're taking on debt to make money. What's the difference between bonds and a long-term notes payable? $20,000 at the bank is a long-term notes payable. A bond for $20,000 could be $21,000 bonds to raise the same funds as a note payable. 20 bonds had to be sold. Why do companies and governments issue bonds? Raise capital. Let's look at some terms. Basic terms. Face value or stated value. I mentioned that in a Chapter 9 video, that face value would be coming down the pike again for us. And it was just more like a prelude to things to come. Well, here we are. Now we need to know what face value is. So a bond is issued at face value for $1,000. It's very important to know that for calculating interest. Maturity date's the final payment due date on the bond. That's when it matures. Contractual interest rate, also called the stated rate or the contract rate, is used to determine cash interest the borrower pays and the investor receives. Market interest rate, and that's the one that makes our life hard. Market interest rates. Right now, at the recording of this video, the Federal Reserve has been raising interest rates. So interest rates have been changing. They've been going up. Interest rates change all the time. They go up and they go down. Now, in the last 15, 20 years, the trend has been down on interest rates, more or less, over time. In the last few months, I'm recording this in 2022, interest rates have been going up. So market interest rate, the rate investors demand on bonds of similar risk. These change over time. Changing market rates while the stated rate remains the same. So the face value and the maturity date, they remain the same. And the contractual rate. So these are like the contract. That's in the contract. The market rate, well, that changes. And because that changes, that creates some interesting things. So if I had a bond I could be buying that was issued last year when rates were low, or a bond now when rates are higher, which one am I going to get? I'm going to take the one that's going to give me a higher rate, which is the bond being sold now. What about that old bond? Well, they got to put it on sale to get me to buy it. So let's talk about it. So principal is amount owed. You know that. Now let's get ready to talk about these. When we pay $1,000 for a bond, or when we pay more or less for a bond, because the market interest rate has changed. So if the market rate and the stated rate are the same, the bond is issued at a face value or par value. At par, both the market rate and the stated rate are the same. So bond is sold for $1,000 is priced at 100% or 1.00 or 100 even 100, which is essentially 1.00. A bond issued at a discount, also issued below par, also called issued below par. At a discount, what has occurred is the market rate is higher than the stated rate. So a $1,000 bond, let's say I got a $1,000 bond and it's 2%. And I could go across, that's one I've had for a year and I'm trying to sell it. And the people across the street, they just bought a bond and they're trying to sell it already. But that bond's paying 4%. There's only one thing I can do. I got to put my bond on sale. I got to sell it for less than $1,000. The only thing I can do. All right? I got to put it on sale because everybody else has got something a little newer and a little nicer. If you want to look at it that way. Got to get you through the rough spot while you're trying to learn this until it makes more sense. So anyway, so when the market rate's higher, I got this bond paying lower. Nobody's going to buy it unless I put it on sale, discount. All right, so the fundamentals are we need to learn the fundamentals in addition to how to think through to get through a test. But a $1,000 bond sells for less than $1,000, such as $980. If it sold for $980, the price would be $98. Because 98.98 times 1,000 is 980. The discount amount is the difference between 1,000 and 980 in this case, or 20. That would be the discount. Now, if I got a bond and rates go down, and not everybody's new bonds, the rates are lower than mine. I want to sell my bond. I get to say, look, this thing's like platinum. It's gold. You're going to have to give me a little extra. We're going to sell it for premium. So, a bond issued at premium is above par. The market rate is lower than the stated rate. So a $1,000 bond sells more than $1,000, such as 101 or 1.01. If it's sold at 101, 1.01 times 1,000, type that in your calculator, is 1,010. Let's say it's 102, then 1.02 times 1,000 is, and it can be 102 without the decimal, by the way. And this could be 1.01 without the decimal. So then 1,020 is the answer. So 102 times 1,000 is 1,020. The premium is the amount over the face value. Well, the face value is 1,000. So looking at 1,020, the premium's 20. Looking at 1,010, the premium's 10. In the next video, we'll start working journal entries, and hopefully some of these terms will begin to make sense.